Maximize your savings. Best investments for retirement. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable information for free. Now let's dive in. Here's something that keeps financial advisors up at night. The average American reaches retirement with just $255,000 saved, but they'll need roughly $1.2 million to maintain a modest lifestyle for 30 years. That gap isn't about saving more. It's about investing smarter, understanding tax-advantaged accounts, and making your money work exponentially harder through strategic asset allocation. Today, I'm going to show you exactly how to bridge that gap, and why the decisions you make in the next 12 months could be worth hundreds of thousands of dollars by the time you retire. Let's talk about why this conversation matters right now. The retirement landscape has fundamentally changed. We're living longer, healthcare costs are rising faster than inflation, and Social Security is replacing less of our pre-retirement income than ever before. The average person will spend 20 to 30 years in retirement, potentially longer than your entire working career. The IRS just announced updated contribution limits for retirement accounts. For 401k plans, you can now contribute up to $23,000 if you're under 50 and $30,500 if you're 50 or older. For IRAs, both traditional and Roth, the limit is $7,000 or $8,000 if you're 50 plus. When you understand the power of tax-deferred growth and compound interest over 2 or 3 decades, we're talking about differences of hundreds of thousands of dollars. Here's something else critical. We're currently in a relatively favorable tax environment, but many provisions are set to sunset after 2025. Tax brackets will likely increase, and the window for strategic Roth conversions and tax optimization is narrowing. The question isn't whether you should be investing for retirement. It's whether you're using the right vehicles, maximizing tax efficiency, and building a portfolio allocation that matches your time horizon. A 1% difference in your investment returns, compounded over 30 years, can mean the difference between a comfortable retirement and having to make difficult lifestyle compromises at 75. Let me break down the 4 fundamental principles that will maximize your retirement savings. Principle 1. Maximize tax-advantaged retirement accounts first. Before you invest a single dollar in a taxable brokerage account, max out your tax-advantaged options. Let me show you why with actual numbers. You're 35 years old. You invest $10,000 annually in a traditional 401k, and you're in the 24% tax bracket. That contribution immediately saves you $2,400 in taxes. That money grows tax-deferred for 30 years. Assuming a 7% average annual return, that $10,000 annual contribution becomes roughly $1 million by age 65. Compare that to investing in a taxable account. You don't get the upfront tax deduction, and you're paying capital gains taxes on dividends along the way. Your actual returns might drop to 5 to 5.5% after taxes, and you could end up with $200,000 to $300,000 less. Traditional 401k and traditional IRAs give you a tax deduction now and let your money grow tax-deferred. You pay ordinary income tax when you withdraw in retirement. This is ideal if you expect to be in a lower tax bracket when you retire. Roth IRAs and Roth 401k's work in reverse. You pay taxes now, but all future growth is completely tax-free. If you invest $100,000 over your career and it grows to $800,000, you never pay taxes on that $700,000 in gains. For younger investors or anyone who believes tax rates will rise, Roth accounts are incredibly valuable. Here's a strategy sophisticated investors use. Contribute to your traditional 401k up to your employer match. That's free money. Then max out your Roth IRA, then go back and max out the rest of your 401k. This gives you tax diversification, meaning you'll have both pre-tax and post-tax money to draw from in retirement. Don't overlook health savings accounts if you have a high-deductible health plan. HSAs are the only triple tax-advantaged account in existence. You get a tax deduction for contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. After age 65, you can withdraw for any purpose and just pay ordinary income tax, making it function like a traditional IRA with better benefits. Principle 2. Understand asset allocation and portfolio diversification. Asset allocation is how you divide your portfolio among stocks, bonds, real estate, and cash. This determines about 90% of your portfolio's long-term returns. More important than which specific stocks you choose. A 45-year-old with 20 years until retirement might use this allocation. 70% stocks, U.S. and international equities. 20% bonds, investment grade and treasury securities. 10% alternative investments, REITs, commodities. Within stocks, you want diversification. Don't put everything in large-cap U.S. stocks. Include small-cap value stocks, international developed markets, and emerging markets. These segments don't always move together, which reduces overall portfolio volatility. For bonds, you're looking for stability and income. Treasury bonds, municipal bonds if you're in a high tax bracket, and investment-grade corporate bonds all serve a purpose. When the stock market drops 30%, bonds often hold their value, preventing you from panicking and selling at the bottom. Here's something crucial. You don't shift to 100% bonds the day you retire. If you retire at 65 and live to 90, you have a 25-year time horizon. A common strategy is to keep 5 years of living expenses in cash and bonds, and keep the rest invested for growth to combat inflation. Principle 3. Harness the power of compound interest and time. Let's compare two investors. Sarah starts investing $500 monthly at age 25. Michael waits until 35 but invests $1,000 monthly, double Sarah's amount. Both invest until age 65 at a 7% average return. Sarah invests for 40 years, putting in $240,000 total. Her ending balance? Approximately $1.37 million. Michael invests for 30 years, putting in $360,000, $120,000 more than Sarah. His ending balance? Approximately $1.22 million. Sarah ends up with more money despite contributing $120,000 less, simply because she started 10 years earlier. That extra decade of compound growth is worth more than doubling contributions. Every single year you delay costs you exponentially more. If you're 30 and thinking you'll start seriously investing at 35, you're not just losing 5 years. You're losing the compound growth on all those contributions for the next 35 years. Dividend reinvestment is compound interest on steroids. When you automatically reinvest dividends, those dividends buy more shares, which pay more dividends, which buy more shares. A stock yielding 3% annually and growing at 7% gives you roughly 10% total returns, but only if you reinvest those dividends. Principle 4. Strategic tax planning and optimization. Tax efficiency isn't about evading taxes. It's about legally minimizing your tax burden so more money compounds for your benefit. First, understand tax brackets. We have a progressive tax system. If you're single and earn $100,000, you're not paying 24% on every dollar. You're paying 10% on the first $11,600, 12% on income from $11,601 to $47,150, 22% from $47,151 to $100,525. Understanding this helps you make smarter decisions about traditional versus Roth contributions. Tax loss harvesting is powerful. You sell stocks in your taxable account that have declined to realize the loss, which offsets capital gains, or up to $3,000 of ordinary income per year. Then you immediately buy a similar investment to maintain market exposure. This can save you thousands annually. Roth conversions during low-income years are strategic. Maybe you retire at 60, but don't claim Social Security until 70. Your income temporarily drops. This is perfect for converting traditional IRA money to Roth, paying taxes at your now lower bracket instead of potentially higher rates later when required minimum distributions kick in. RMDs, required minimum distributions, start at age 73. The government finally wants its tax money on tax-deferred accounts. But RMDs can push you into a higher tax bracket, increase Medicare premiums through IRMA surcharges, and cause up to 85% of your Social Security to become taxable. Qualified charitable distributions allow you to donate up to $105,000 annually directly from your IRA to charity after age 70 and a half. This counts toward your RMD, but isn't included in taxable income. If you're charitably inclined, this is substantially more tax efficient than taking the RMD, paying taxes, then donating. Let's talk about what you actually do starting tomorrow. Step 1. Calculate exactly how much you're currently saving. Pull up your 401k statement, IRA balances, and taxable investment accounts. Use a retirement calculator to determine if you're on track. If there's a gap, address it now. Step 2. Increase your retirement contributions immediately. If you're not maxing out your 401k employer match, you're leaving free money on the table. Increase contributions by 1 to 2% of your salary. If you get a raise, increase contributions by half the raise amount. Step 3. Open or max out a Roth IRA. Fund it with $7,000 or $8,000 if you're over 50. Do this every single year. If you're above income limits, look into the backdoor Roth IRA strategy. Step 4. Review and optimize your asset allocation. Create an allocation matching your age, risk tolerance, and goals. Rebalance annually. Step 5. Automate everything. Set up automatic 401k contributions, automatic IRA transfers, and dividend reinvestment. Automation eliminates the willpower problem. Step 6. Consider working with a fee-only fiduciary financial advisor as your situation becomes more complex. They can help with advanced strategies like estate planning and sophisticated tax optimization. Maximizing your retirement savings isn't about perfectly timing the market. It's about consistently doing the right things, maxing out tax-advantaged accounts, maintaining appropriate asset allocation, letting compound interest work, and optimizing taxes. The decisions you make today compound, just like your investments. Small improvements in your strategy today become massive differences in financial security 30 years from now. You now understand retirement account types, asset allocation principles, compound interest power, and tax optimization strategies. But knowledge without action is just entertainment. The best time to start was 20 years ago. The second best time is right now. Your future self, retired, financially secure, able to enjoy those years you've worked for, is counting on the decisions you make today. If you found this valuable, hit that subscribe button so you don't miss videos on Social Security optimization, estate planning, and creating multiple retirement income streams. Comment below with your biggest retirement planning question or share one insight that resonated. Click that thumbs up button. It helps us reach more people who need this information. Disclaimer. Important disclaimer. I am not your financial advisor, and nothing in this video constitutes personalized financial advice. Everyone's situation is unique. The strategies discussed are general educational information. Before making significant financial decisions, consult with a qualified financial advisor, tax professional, or certified financial planner who can review your specific circumstances. Investment returns are not guaranteed, and all investing involves risk, including potential loss of principal.